Hi everybody. Today is April 2nd, 2009, and this is my second video. And I got a lot of positive response from the first one, so I thought I would continue doing it. As long as you are enjoying it and getting value out of it, then I'll keep doing it. Okay, I've got a few things I'd like to talk about today, and one is mark-to-market accounting. That's big in the news. Also the uptick rule, and also the recent G20 meeting that just finished in London. Okay, mark-to-market accounting. You may have heard that the mark-to-market accounting rules have been amended to help financial institutions maintain their reserve requirements. Okay, what exactly is mark-to-market accounting, and how does this help financial institutions? Well, mark-to-market accounting for banks, brokerage firms, insurance companies was implemented back in the early 80s. And I recall it vividly because at the time I was working a lot with savings and loan institutions and advising them about getting into the financial services business. And what it basically is in fact, back then, I believe that the mark-to-market rule, and I think a lot of commentators would agree with me, that that rule actually did a lot to help collapse the savings and loan industry. It probably would have collapsed anyway, but it sort of expedited things. Basically, financial institutions, banks, insurance companies, brokerage firms, etc., are required to have reserves. So let's say you're a bank and your requirement is $100 million. Well, prior to mark-to-market, basically reserves are kept as bonds, and you could put those bonds on your balance sheet at face value, meaning that upon maturity they're worth $100 million, and that's what you get to put on your books regardless of what their market value is. As you all know, bonds change in value prior to maturity. Some of the things that influence the value of bonds: interest rates, the quality of the issuer, etc., etc. So if you have an unfavorable bond market and the values go down, then you could fall below your reserve requirements fairly rapidly and not have a facility for replacing that loss quick enough to keep the regulators happy, in which case then you'd be considered non-compliant and you'd be shut down or taken over or whatever. Okay, so the rule now, because of what's happened recently where fixed income has really gotten hit hard, is one of the reasons why so many banks have failed and failed so dramatically and rapidly, is because of the fact that they're required to mark-to-market, and their reserves fell short very quickly because of the value of their reserves, bonds. Okay, so hopefully they'll get some relief there, and I think that's, that news that came out today is one thing that helped the market today. We had a fairly strong rally in the market today. Also, the uptick rule, that's what I want to talk about. The uptick rule has to do with short selling. Now, I don't want to get into a discussion of what short selling is. I don't have enough time. I got to keep these videos under 10 minutes. Otherwise, I can't upload them. So, basically, the uptick rule required, and this is something that was implemented back in 1929, and just recently it was eliminated back in July of 2007 for some reason. In any case, the uptick rule stated that before you took a short position in a stock, and by taking a short position, you're betting and hoping that it's going to go down in value. If it goes down in value and you've got a short position, you're going to make money. Again, I don't have time to explain how it works, but maybe I'll do a video just on short selling at some point. So in any case, the uptick rule stated that prior to taking that short position, the previous trade had to be a positive one, had to push the stock up a little bit. And the reason for the rule was if a stock was being clobbered, they didn't want, short sellers jumping all over it and then just running it into the ground, which has happened recently with some stocks. So they're reconsidering the rule, and it looks like, if you believe most of the commentators out there, that it is going to be addressed and reinstated sometime here in the next month or so. Along with the uptick rule with short selling, there's been also something else that's been going on, and that's been naked short selling. Basically what that is selling a stock short without borrowing it first, which, without explaining that, basically what can happen if you don't borrow the stock first and sell it short, you could theoretically sell way more shares short than actually exist out there. So you can really clobber a company by naked short selling. Actually, it's illegal, but there's kind of loopholes, and they're working on fixing all that. So soon to come. The final thing I wanted to talk about was the recent G20 meeting. Perhaps some of you have been following that. They've come out of there with a $1 trillion stimulus package, global stimulus package, and in my opinion, I think it's just the beginning. So some more printing of money, more inflating currency, and so on and so forth. Also, and I'll be curious to hear some of the conversations that came up in the G20 meeting with respect to replacing the dollar with something else as the world currency, world reserve currency. Maybe some of you have heard, China has said, we ought to do something. We ought to get rid of the dollar and do something else for a world reserve currency. And I think Russia, Japan have kind of piped up as well. And some of the talk is, well, what are you going to replace it with? And, they're talking about replacing it with a thing called SDRs. Now, SDR stands for Special Drawing Rights. SDRs are issued by the International Monetary Fund. They've been around for a long time, but there's not that many of them out there. I think the total allocation worldwide is less than $25 billion, which, on a global scale, that's not very much. But, what exactly is an SDR? It's rather confusing. But, in fact, it's so confusing, I think even the International Monetary Fund, the people that issue them, don't really quite understand them. Their definition of an SDR is, and I'm quoting, "The SDR is neither a currency nor a claim on the International Monetary Fund. Rather, it is a potential claim on the freely usable currencies of International Monetary Fund members." Okay. The current exchange rate for an SDR is about $1.50. So, and I think at the G20 meeting they're talking about expanding it to $250 billion. So that's significant. It's 10 times what's out there now. All of this fiscal expansion gives credence to that cash bubble I've been talking about, the coming cash tsunami. When that explodes, look out, we'll probably see bubbles all over the place. Stock market, commodities, real estate, who knows what. Hopefully it bursts slowly so we can, reposition and hopefully take advantage of things. One thing to keep in mind, obviously, as always, being prudent, diversified, vigilant, and that's our job, and your job as well as an investor is to be informed. And I'm doing my best to keep you informed by making these videos, and also the luncheons that we do and the newsletters that we send out. So that's the video for today, and that's it. So I'm signing off, and like I say, I'll just keep doing this as long as you guys are getting something out of it. I'll keep doing it, and any feedback would be welcome, even criticism. I could take it. I've got strong shoulders. I can handle that. That's it for now.